Hello, ladies and gentlemen, and welcome to another podcast on the basics of financial accounting. My name is Jean-Pierre Bruwer, better known as JP Bruwer, and as mentioned, I am a silent facilitator on the Entrepreneurial Skills Development Program. What I want to do for this specific podcast is to focus on answering case study 6.1 and case study 6.2. Now, unfortunately, I cannot open the case study 6.1 and 6.2, the actual text, but I can provide a brief summary. After working through each and every single case study, it is important, I'm just going to mention first off, that we become the person or the people in the case study. For case study 6.1, there's a person with the name of Thabo. And for case study 6.2, there is a person with the name of Nancy. Now, this is not just applicable to these two case studies, this is applicable to all case studies. Whenever you do a case study, you have to become the case. So, for case study 6.1, we are going to take on the being of Thabo. Alright, so I'm going to open up a new slide. And I'm going to write there what I have read based on case study 6.1. We know that Thabo is involved in the restoring, reupholstering, repairing, and repainting of old furniture. So, we have old furniture which is being restored, repainted. Oops, that's A. Looks I'm just too excited to write. There's also repairing, and there is reupholster. This is what Thabo does. Okay, and this takes place in his garage. Just want to write there, garage. Please note, I make use of abbreviations. I am very lazy to write. After this has been said, we also need to take note that nothing has yet been received in terms of funds or infrastructure. So Thabo is just basically planning as to what he wants for his business. But it appears that Thabo's main business is the restoring, repainting, repairing, and reupholstering of old furniture. Now, what we have to do now for this specific question is to answer what assets, equity, and liabilities may be inside the business of Thabo. When we look at assets, we know that from the previous podcasts, assets are resources which we control because of a past event which will result in future inflows of economic benefits. We can see that since there will be old furniture involved, we can write furniture. That should be R, this one. There should be furniture involved because it's old furniture which will be restored, repainted, repaired, and reupholstered. There may also be machinery involved, and there may also be equipment involved. Now, you may wonder, but JP, where on earth do you get this? In terms of machinery, maybe we need a sanding machine in order to sand the wood of the old furniture in order to put varnish on again. And the equipment, this may include a paint can, which we have to fill up and then spray the relevant furniture with paint. In addition to this, we also see that there's a garage, but we are not sure as to whether Thabo owns the garage or whether he just rents the garage. So from my point of view, I am going to write the property and even buildings. It is not clear as to whether this will indeed be the case, but the question itself says which assets, equity, and liabilities may appear in the books of Thabo. One more thing that is not really that clear is whether Thabo is going to restore, repaint, repair, and reupholster old furniture as a service rendering business or as a trading business. In other words, whether he will do this on behalf of other people to make their old furniture new again, or whether he is going to buy old furniture, revamp it, and then sell it off to other people. If he is a trading business, there will most likely be inventory involved. I'm going to touch base on that a bit later. Something else which may appear as an asset is that of bank and also debtors. Because it may be the case that Thabo gives some of his own money in order to start up this business. It may also be that Thabo sells the inventory on credit. There may also be long-term or fixed deposits. I'm not going to go into that extensive depth, but these are the assets we can say is, well, it's logical to put them in. So if you had any of these assets among other assets, they would be acceptable. Remember, as mentioned in the very first slide, you are Thabo in this example. So you need to put yourself in Thabo's shoes at all times for this specific question. I'm going to make a new slide just to cover liabilities. The interesting thing about liabilities is that we are unsure as to whether Thabo will fund himself or whether he will get money from external parties in order to fund the business. Because it is mentioned there that there is no funding secured as of yet. So it may be that there are loans inside the business. Taking into account also that there may be inventory involved, this inventory can be bought on credit from creditors. And this is now from suppliers. These are the liabilities which I believe may pop up. There's also something which I hope is not the case, but bank overdraft. Because we are not sure as to whether Thabo's business has got a very good liquidity, or whether it will have a good liquidity for that matter. So that is in terms of liabilities, which I believe may be possible liabilities, which may appear in the books of Thabo. Then we have equity. As mentioned to you, equity is a double-edged sword in this case, because we have no idea as to whether this particular business will be a service rendering business or whether it will be a trading business. If it is a service business, we will most likely have to make use of services rendered as the main income. However, if we make use of a trading business, we will have to make use of something called sales, meaning that there will also be cost of sales involved. Again, I will get to the differences between a service rendering business and a trading business in due course. This is going to be an income, services rendered and sales will both be income, and cost of sales will be an expense. Furthermore, it is highly likely that Thabo will work during the nighttime, because it is a lot of work to reupholster, repair, repaint, and restore furniture. So we can say that there may be electricity, there may be water, and the other thing which also stands out, based on our discussion here, we don't know whether Thabo owns the property or buildings, the specific garage. He may also be renting, so there may be a rent expense. Furthermore, there's taxation involved, or can be taxation involved. There may be salaries, there may be wages, etc. There are many more examples of equity which one can put in. Two of the main equity items which I did not include, which should have been included at the very top, is that of capital and drawings. Now, again, we are unsure as to whether this will be self-funded or whether it will be funded by means of loans from external parties. And if there's no money to withdraw, it will also impact on drawings. But for the sake of clarity, let's just say we may have capital, we may have drawings. All right. So based on all of this, I believe case study 6.1 has been addressed fully. Again, this is just a suggested solution. It is not the actual solution, because there are many ways to interpret a case study itself. Okay. Now, as promised, I'm going to discuss the differences between a trading business and a service rendering business. Why? Well, we specifically need this information for case study 6.2. We have a service rendering business and we have a trading business over here. Let us say it's just one business over here, and I'm going to split this business into two because this will be related to service and to trading. So I'm going to call the business business, and there's the doors. Okay. A service rendering business is a business that renders services to the general public, which can be people. Oops, well, not connected, I see. Anyway, now it's a bit connected, or to other businesses. This service can include gardening service, cleaning service, and even what you are experiencing in the Entrepreneurial Skills Development Program, you are getting a type of teaching or training services, all right, or education services. That's the right term that I wanted to use. These services are rendered to either people or businesses. And when services are rendered, it is either rendered for cash by means of bank, or it is rendered on credit to debtors. Services rendered will be the main income in a service rendering business, while it can either be that we receive money from customers or businesses for the services rendered, or we say to them, listen, you get the service now and you pay later. That's a service rendering business. Also, for additional clarification, services rendered is part of equity. Oh dear, what happened there? There we are. That's equity. Let me just also remove that extra blob. And services rendered, since it's part of equity, we know that services rendered is part of income. It will have a positive influence on equity. Bank and debtors, on the other hand, they will be assets, and it will have a positive influence on assets. With a trading business, it is a business that sells products. I'm going to draw products. Please excuse my drawings. It is, well, it's one of a kind. These are products, and these products are either sold off to customers or to fellow businesses. Now, the key thing here is that in order to get these products, a business needs to buy it. Hence, first of all, before any products can be sold, we will have to take into account that inventory will have to become more, and inventory is part of assets, become more, and inventory can either be bought with cash, oh, not bank, apologies. I'm just overly enthusiastic again. Apologies for the inconvenience. That's an N and a K. Can either be by means of bank or by means of creditors. A creditor is a liability, and in this case it will become more if we buy products on credit, and for bank it is an asset that becomes less because we use the money to buy. Whenever we sell inventory, there will be a sale that is recorded, and sales, it is part of equity, positive. It is the main income of a trading business. And this sale can either be made in cash, where we have bank, that's A, asset which become more, or it can be debtors, asset which becomes more. But whenever we sell products, our products will also become less. So we also have to take into account that inventory, part of assets, will become less, and we will have cost of sales, which is part of equity. It is the main expense in a trading business. So this is the difference between a service rendering business and a trading business. Okay. Let us go to case study 6.2. And as mentioned, case study 6.2, we have to take on the persona of Nancy. I'm not going to talk in a very high-pitched voice. I'm just going to talk in my normal voice, even though I am Nancy. Now, when we read through this specific case study, we can see that there are many different transactions which take place during the course of January. First up, we read that there's a capital contribution by Nancy in cash. Inventory was bought in cash. Equipment was bought on credit. Electricity was bought for cash. There was a sale made in cash, and there was drawings in the form of cash. What the very first requirement is for us to identify the accounts which stand out. When we read through this specific case study, and we see that Nancy contributed money to start up the business, we know immediately that it relates to capital. What's going to happen is that we will have something called bank. That is the cash component, and will have capital. What is wrong with this pen that I'm using? Apologies. That should not be a U, that should be an A. Capital. That's the very first transaction which we read of. Bank will become more, and we know that bank is part of assets. Just going to write an A there, and we know that capital is part of equity, and this should also become more. The next transaction which we read of, it's ingredients which were bought to make something for a client. Now, whenever we buy something to make something in order to sell this specific something, it means it is part of inventory. So we can write inventory, which is part of assets, will become more, and we purchase inventory with cash, which means it's an asset which becomes less. This is how I identify the particular accounts for each and every transaction. Next, after the comma, we will see that there's equipment which were bought on credit to the amount of 3,000 Rand. What we will have now is, let's see if I can fit it in here, equipment, which became more. We know that equipment is part of assets, which becomes more, but this was bought on credit. And we know that when we buy on credit, there will be something called creditors, which we will use, and it will influence liabilities as it will become more. Next up, we will also see that electricity was bought for the prepaid meter. Now, all electricity are normally paid for cash. So we will have electricity and we will have bank. Based on our previous podcast, which we discussed assets, equity, and liabilities, we know for a fact that electricity is part of equity, and we know that it will have a negative influence on equity. Therefore, equity, negative. That's electricity. Bank is part of assets because bank will become less. We paid for electricity. Next up, there was a sale. This particular sale, if I can just go back, this sale, which we will have to take into account, will take place because we actually bought inventory previously. Now, where on earth did we buy inventory? Right over there. We bought inventory for cash. So, in actual fact, there was inventory and there was bank. Now, we are also going to sell this specific inventory. This inventory, which we sell, will take place by means of a cash sale. There will be sales involved, inventory, and cost of sales. So, let's take this step by step. First of all, we will have the bank account, which becomes more because we receive money. Specifically, we receive a total of 5,000 Rand. So bank becomes more. Why does bank become more? Because of sales. And it's part of equity. As mentioned, it is the main income for a trading business. Furthermore, although we made a sale, we have to take into account that our inventory will also become less. So the inventory which we had will become less with the amount of 2,000, and our cost of sales, we know, is a main expense for any trading business, meaning that it will form part of equity and it will have a negative influence on equity. This is the sale which took place. The very last transaction is that the owner, who's Nancy, she withdrew money for personal use to pay, etc., etc. Whatever the reason is why Nancy took money for personal use, it's not our indaba. We are just interested that this specific taking of money was for personal use. Whenever there's money taken for personal use, it is a drawings. Drawings, we know, is part of equity, which will negatively be influenced. And what was taken? Well, bank was taken and bank became less. So money became less in the business. In terms of the requirement for 6.2, case study 6.2, number 1, we had to identify the accounts which influenced all the relevant transactions. The first two was bank and capital, followed by inventory and bank, equipment and creditors, electricity and bank, followed by bank and sales altogether, which totaled 5,000, and inventory and cost of sales, which totaled 2,000, meaning that there was a total of 3,000 profit made on the sale, which is not bad at all. And the last two accounts were drawings and bank. Next up, and the last requirement for case study 6.2, we are asked which of these accounts will now be debited and which accounts will be credited. Now, believe it or not, we have actually done the work already on the screen as it appears now. Let me explain. If you go back to the previous podcast, you will remember that assets is equal to equity plus liabilities. Look at this beautiful sketch. Plus minus, minus plus, minus plus. All assets become more on the debit side. All assets become less on the credit side. For equity and liabilities, they become less on the debit side and they become more on the credit side. So all that we have to do is to take our knowledge from the accounting equation table and apply it accordingly. Bank is a positive asset, meaning that there will be a debit entry over here. Capital, equity plus, meaning that there will be a credit entry. Can you see how easy this is? We have done all the hard work already. In terms of inventory, it's an asset which becomes more on the debit side. Bank became less, it's an asset minus, meaning that it will be a credit. The next one is equipment. Assets became more, it will be debited. Creditors, it's a liability, meaning it became more, so it's credited. Electricity, negative equity. We know for a fact that it will be a debit. Bank minus assets, it is a credit. Bank plus assets, there will be a debit. Sales is part of equity positive, meaning that it will be a credit. Inventory became less, it's part of assets, meaning that there will be a credit. Cost of sales, there will be a debit. Drawings will have a negative influence on equity, meaning that it will debit. And bank, negative asset, meaning that it will credit. This is how easy accounting is. As mentioned in my previous podcast, if you understand the basics of accounting, you can do almost anything in accounting. That's how powerful accounting basics are. With this being said as well, you will pick up that in each block, there are both debits and credits, which stand out. The funny thing here is that in the discipline of accounting, we have something called the principle of duality. Now, duality comes from the word dual, which means two. For every debit, there is an equal and opposite credit. Look at this. The bank and the capital accounts were debited and credited respectively with the amount of 10,000 Rand. For the next one, inventory and bank, it was influenced by 4,000 Rand, but there was a debit and a credit entry. The same with equipment and creditors, the debit and credit entry of 3,000 Rand. Electricity and bank, the amount was just 500 Rand. For sales and for bank, there was a debit and credit entry of 5,000 Rand. For cost of sales and inventory, the amount was 2,000 Rand. And for drawings and for bank, the very last transaction, it was just 1,500. Hence, your debits should equal to your credits. Also, it justifies the fact that all assets are equal to equity plus liabilities, meaning that everything is absolutely nah. So whenever our debits are equal to credits, it means we are happy. I know my drawings are not that wonderful, but anyway, you get my idea. Ladies and gentlemen, this is the end of my podcast for the answering of case study 6.1 and 6.2. If you have questions on case study 6.1 and 6.2, you're welcome to send me an email at bruwerjp@cput.ac.za. Thank you for watching and all of the best with your further studies in the Entrepreneurial Skills Development Program.